Right now, as we watch the ticker tape scroll across the screen, Datavault AI Inc., trading under the symbol DVLT on the NASDAQ, is sitting at exactly $1.65. We are looking at a downward movement today, specifically a drop of $0.050, which translates to a decline of roughly 2.94% for the intraday session. If you are staring at your screen wondering why a company with AI in its name isn't defying gravity every single second, you are not alone. The market expectation right now, driven by the massive headlines we see from the likes of NVIDIA stock, is that anything adjacent to artificial intelligence should be printing green candles endlessly. But the reality is far more nuanced and, frankly, far more interesting for anyone who takes stock analysis seriously. What we are witnessing at $1.65 isn't a failure of the business model, it is a textbook technical consolidation in the face of broader market volatility, and we need to tear this apart to understand what is actually happening beneath the surface of that price tag. When you see a stock like Datavault AI slide nearly 3% in a single trading session, the immediate knee-jerk reaction from the retail crowd, perhaps those checking their balances on the Robinhood app or glancing at their Fidelity mobile app during a lunch break, is fear. They see red and they assume something is fundamentally broken. However, if you zoom out and look at the market mechanics at play here, the story changes. This $1.65 level is critically important. We are hovering just above a support zone that technical analysts have been watching for weeks, specifically around the $1.63 mark. If the price holds here, this intraday dip isn't a sell signal, it's a stress test. It is the market asking, are the buyers at this level serious? In the world of online investment, where algorithms and high-frequency traders dominate the flow, these tests are necessary to build a floor for future price action. You cannot build a skyscraper on a swamp, and you cannot build a sustainable rally without testing support levels. Let's talk about the volume. Usually, when you see a drop of nearly 3%, you want to check if it is being driven by institutional dumping or low-volume retail panic. Today's action suggests the latter. The volume isn't screaming exit liquidity, it looks more like profit-taking and rebalancing. Think about how a platform like Schwab Intelligent Portfolios works. These automated systems are designed to mitigate risk. When a small-cap asset like DVLT has had a volatile run, and make no mistake, Datavault has seen some massive swings recently, these automated portfolios often trim positions to maintain asset allocation rules. This creates selling pressure that has nothing to do with the company's fundamentals, and everything to do with portfolio mathematics. If you are engaging in self-investing or managing your own individual brokerage account, you need to be able to distinguish between a broken stock and mechanical selling. What we are seeing today at $1.65 feels essentially mechanical. This brings us to the core tension I want to explore, the gap between the AI hype expectation and the data monetization reality. Most people buying into this sector are looking for the next NVIDIA stock. They want hardware, chips, and massive infrastructure plays. Datavault AI isn't that. If you are buying DVLT expecting it to move in perfect correlation with semiconductor giants, you are looking at the wrong map. Datavault AI is fundamentally a data valuation company. Their business is not building the brains of AI, it is providing the receipts for the data that feeds it. That is a finance play wrapped in tech clothing. So when we see the stock down at $1.65, we have to ask, has the thesis changed? The answer appears to be no. In fact, if we look at recent filings, the thesis is hardening. The company recently reported a Q3 revenue increase of 148% year over year, hitting $2.9 million. Now, for those of you used to looking at the balance sheets of Apple stock or Tesla stock, 2.9 million might sound like a rounding error, but in the microcap space, a triple-digit percentage revenue increase is a massive signal of traction. It means the technology is leaving the lab and entering the market. They aren't just talking about valuing data, they are getting paid to do it. The disconnect between that revenue growth and today's minus 2.94% price action is where the opportunity and the risk live. The market is inefficient. It takes time for the weighing machine of the stock market to catch up to the voting machine of daily sentiment. I want you to pause for a second and think about your own portfolio. Comment below with how many shares of Datavault AI you currently hold, or if you are waiting for a specific price entry point like $1.50 or $1.60. It's always fascinating to see where the psychological lines in the sand are drawn by the community. Continuing on this track, we have to address the elephant in the room: volatility. Small-cap tech stocks are inherently volatile. If you use interactive brokers, stock trading platforms, or similar advanced tools, you know that the beta on a stock like DVLT is significantly higher than the broader market. A 3% move for Datavault is like a 0.5% move for a blue chip. It's standard deviation behavior. However, the retail sentiment often fails to account for this. We see investors on SoFi stocks forums or Reddit threads panic selling the moment a small cap dips, only to watch it rip higher 3 days later. This behavior is what institutional money preys upon. They wait for the flush where retail investors capitulate, and then they scoop up shares at the support level. At $1.65, we are dangerously close to that buy zone where the smart money often steps in. Let's contextualize this with the broader online investing landscape. If you are using Fidelity Wealth Management Services or looking at Fidelity Mutual Funds, you are rarely exposed to this level of granularity unless you specifically seek it out. But for the active trader using the Robinhood app or managing a SoFi active investing account, DVLT represents a high-risk, high-reward vehicle. The appeal here is the asymmetry. You don't buy Datavault for a 5% annual dividend. You buy it because you believe the market cap is mispricing the intellectual property portfolio. Datavault holds patents on data valuation and tokenization. If the world moves to a Web3 or tokenized real-world asset economy, those patents become defensible moats. The market, in its short-term wisdom, struggles to price intangible assets like patents until they start generating cash flow. We are seeing the early stages of that cash flow now with the Silex deal. Speaking of Silex, this is a critical piece of the puzzle that explains why the $1.65 price might be deceptive. Datavault recently secured a strategic investment involving Silex Holding Company. We are talking about a deal structure that validates Datavault's technology in the healthcare and biotech space. They signed a $10 million licensing agreement. In the world of microcaps, a $10 million deal is a company maker. It proves that the data value platform isn't just vaporware, it has a commercial application for valuing genomic and therapeutic data. When a biotech company is willing to pay to use your data valuation standards, you have crossed the chasm from concept to product. Yet the stock is down today. Why? Because the market often sells the news. The announcement happens, the stock pops, and then the slow bleed of profit-taking sets in. That is likely what we are seeing at $1.65, the digestion of previous catalyst events. If we look at the competition, or rather, the lack thereof, it gets even more intriguing. Who is the direct competitor to Datavault AI? It is difficult to name one directly. You have massive cloud providers like Microsoft or Amazon, but they store data. They don't necessarily provide a third-party audit of its value for balance sheet purposes. You have consulting firms, but they lack the automated software platform. Datavault is trying to carve out a niche as the Moody's of data. Just as Moody's rates bonds, Datavault wants to rate data sets. If they succeed, the current market cap will look laughably low in retrospect. If they fail, or if the market refuses to adopt their standard, the stock goes to zero. That is the binary risk profile you accept when you click buy on your Fidelity trading platform or Interactive Brokers account. Let's discuss the macro environment. We are in a period where interest rates and inflation data are constantly buffering the tech sector. When rates are high, future cash flows are discounted more heavily. This hurts growth stocks the most. Datavault AI, being a growth company with the bulk of its earnings expected in the future, is highly sensitive to the Federal Reserve's posture. If the Fed signals higher for longer, stocks like DVLT suffer. If we see rate cuts on the horizon, these are the assets that tend to coil like a spring. Today's drop to $1.65 could also be a reflection of broader sector rotation, where money is moving out of speculative tech